What's going on, guys? Welcome back to the Roll-Up. For today's episode, we take a jump back into time when we first covered Maverick Protocol years ago on DeFi Slate and have now kind of been faced with the question in the modular ecosystem as to where the apps are. So we decided to have Bob Baxley, the founder of Maverick, on the show to talk about where DeFi goes from here, the innovations that have happened in DeFi, and where he sees this entire ecosystem of on-chain applications heading in the future. Also, whether or not Maverick's going to launch an app chain and how Bob feels about owning block space. I hope you guys are interested in the evolution of AMMs and DEXs because we talked quite a bit about that as well towards the end, and some AI programmability things. Hope you guys enjoy. Let's jump right in after a quick word from our sponsors.
Welcome aboard on our journey into the singularity. This is the endgame roadmap for Frax and Fraxtal, the new L2 out of the Frax ecosystem that is totally based on fractal scaling. Fraxtal is a modular L2 blockchain built by Frax with modular and fractal scaling in mind. Fractal scaling is based on the Mandelbrot set of fractal images, and it explains how L2s become L3s and the entire app chain lifecycle goes through its evolution. The Frax ecosystem is made of some of the top builders in the space and has stemmed from its OG days of the Frax stablecoin. It is now in the LST space, the LRT space, and this Fraxtal L2 joins the existing suite of Frax products, including Frax Swap and Frax Lend. You can see Frax Ferry, the bridge to go from any chain, Arbitrum, Optimism, or mainnet into the Fraxtal mainnet. Bridge your tokens and bring your Frax assets into the Fraxtal ecosystem. Join today to get the best out of Fraxtal. You are still early. Join today. Take part in our expedition into the singularity.
Covalent is solving the long-term data availability problem where a lot of the data availability providers today in the modular space, when you post data to them, they actually only hold that data for about 12 to 16 days. And then it's basically, it can go into an archive node, or oftentimes it's just kind of put away into the abyss. And what Covalent's trying to do is build this long-term data availability solution, which can plug into some of these modular data availability providers and provide this longer-term perpetual data solution. So what we try to think of this as is when you post transaction data onto Celestio or Veil or any of these modular DA solutions or even Ethereum, Covalent is able to provide a long-term data storage and data availability platform for that data after the time period. Blockchains are billboards, not databases, and we need these providers in the space to be able to kind of hold on to the long-term data that is provided from these providers and these blockchain state. This is where Covalent comes in. They just had a nice rebrand. Check them out on Twitter as well as the website. Thank you for being here. Hope you enjoy the rest of the show. What's going on, guys? Welcome back to the Roll-Up. Today we have an episode with our good friend Bob Baxley of Maverick Protocol to address some questions from the community and that we have at the Roll-Up. As we've kind of shifted focus into more of this modular ecosystem and different kind of proponents happening at the infrastructure level and at the scaling level, there's been quite a few developments that I think that we should cover at the actual application level and DeFi level. And I think this pod will be good to kind of answer the question that we've been getting a lot, which is like, where are the apps? And so maybe we can talk a bit about kind of some of the evolutions of DeFi, where DeFi is going, and more. Maverick has just pushed out their V2, so I'm sure Bob has quite a bit to share about that. And yeah, Rob, of course, welcome in, GM, like it says on your shirt. And yeah,
one of my favorite pieces of merch. Shout out Geyser. So we started out pretty heavily focused on DeFi quite a few years ago, and the space has come a long way. Not sure if you guys see it similarly. Curious to hear your perspective, but I tend to see these ebbs and flows where we got Ethereum, and then all of a sudden and Ethereum was the infrastructure, and then we got a wave of applications in DeFi summer, and we got Maker, we got Aave, we got all these DeFi applications, and then we kind of hit capacity at the infrastructure level, and then so we had to kind of like go back, work on scaling some of these protocols, scaling the base layer and the infrastructure before we could see another wave of applications go live. And so, Andy, to your point, we've been spending more and more time on the infrastructure level. There's been a lot of scalability conversations, a lot of work being done and research being done at some of the protocol in infrastructure levels. And so, kind of like time to see the fruit of all that labor at the application level. And so, Bob, welcome to the show. Really, really keen to kind of hear your origin story, where you've come from, and then ultimately bring us up to speed on Maverick V2, and just kind of like your general perspective on how you're seeing DeFi evolve in the recent years and going forward.
Sure. Yeah. Hey guys, thanks for having me. Happy to be here. So my background, I was a academic. I was at Georgia Tech for a number of years doing information theory and signal processing. And then I spent almost a decade running tech as a CTO of a cybersecurity Web2 startup, and then jumped into DeFi Web3 a few years ago, built out the Maverick AMM. I think it's a great question. We've seen new infrastructure, slow infrastructure with the original EVM, now fast infrastructure with L2s and Solana. And I think, and we've seen really interesting apps come on top of that. To me, kind of the next wave that's coming is, I'm pretty excited about AI Web3. And I think things like ZKML, where you can do off-chain heavy compute and then in a provable way, so you can do it trustlessly, and then bring that into DeFi apps, is going to be the next big wave coming. So, Uniswap V3 or V4 has some neat stuff with hooks. Maverick V2 has programmable pools, which is a variation, but a similar sort of idea where you can put kind of heavier duty logic inside of a swap or add liquidity call or any of these calls. And so to me, the folks building out kind of off-chain compute, doing ML compute off-chain, whether it's optimistically or with zero knowledge proofs, is a really neat space that's going to start to infect DeFi apps.
Yeah, so we've heard of ZKML on the show, maybe just once or twice. And I've seen some projects working in that space as well. Would love to just have a pretty broad understanding of kind of what that process is and how it kind of works. So we've got these models and inferences off chain, and then we're able to bring that on chain to do some higher level or basically more complicated or complex actions. Yeah, we'd love to really kind of break that down and understand how this off-chain AI kind of aspect comes on chain, and what further understand how it works.
It's super cool tech. I think the Web3 is really driving all kinds of really neat, encryption and verification tech. So the idea in ZKML is, so let's just back up into a use case. So say you want the inference of a model on chain. You want to use it as part of a smart contract interaction. Okay, so an example would be a DeFi, a DEX, where so Maverick V1 had these neat ways where, depending on the price, you as an LP could choose to move your liquidity. So these are fairly simple rules, a very simple model. You could think of it about inputs, and then the outputs would be where liquidity would move. You could imagine much more sophisticated models with lots of inputs that have a more nuanced output. Okay. And so, and this is what, TradFi, more sophisticated finance, has much more sophisticated models than what we can do on chain. And the limitation on chain is gas. So the validators running these computes, the compute of smart contract interaction, it's very, very limited. It gets very expensive from a gas perspective. And then smart contracts on EVM chains are limited to 24 kilobytes. So there's not enough room to put a giant model on chain. Okay, so we've got this use case. I want to do something sophisticated on chain, or I want to use a sophisticated output as part of a smart contract interaction. One way you could do it is you could use just an oracle. So you could think of like Chainlink is doing this. They take a whole bunch of price data off chain, and they kind of, in a trusted way, write it to a contract so that you can then read it from their oracle contract in your smart contract and do something with it. So there's Oracle-based DEXs out there that are using Chainlink feeds, Pyth feeds to organize how they price swaps. That's kind of the trusted way to do it, the 1.0 way to do it. A more interesting way to do it is with the machine learning model. You have some way to prove that whoever is writing essentially the Oracle output on chain has done it in some verifiable way where you no longer have to trust them. All you need to do is specify what they need to do, and then you can have some ZK proof show that they did that thing. So to make that more concrete, imagine you have a model that takes the inputs, say prices from various DEXs or depths from various DEXs or both of those things. And the model has been trained to output the new fee for an AMM on the next swap. And so processing all that data on chain would be intractable. Hiring somebody to do it where you just trust that they've done that inference faithfully and they've taken the output and actually written the right fee to chain is a way to do it, but there's tons of trust there. Say they lose their key, somebody could do a malicious fee, malicious things can happen. So the idea in ZKML is you don't have to trust them. In addition to running that model, they instrument the model with a ZK prover circuit. And the output is both an inference and a ZK proof. And that ZK proof can be concisely proved as part of the smart contract interaction. So now anybody, you don't even need a permissioned thing. Anybody could go run this model at however the system's set up. So if you can run the model any block you want, say, then anybody could do that. And they could write the proof to chain and prove that they've run the model. And in doing that, kind of affect that the fee changes. So that's the power of that's what I think is the biggest part of the Web3 AI narrative is this ability to do inference off-chain, super heavy-duty compute off-chain in a trusted or trustless way. And then you can use that output in dApps, including DeFi.
Cartesi is your home for app-specific rollups. At the forefront of developing new tools and platforms that enhance the capabilities of blockchain technology, Cartesi enables applications that are flexible and built to scale. Build on a full Linux environment and use traditional software libraries, but in blockchain development. Go to cartesi.io, that's cartesi.io, to learn more about building your own app chain today.
Everclear is pioneering the clearing layer. The clearing layer can almost be thought of as splitwise when you go on a trip with friends, but for the blockchain. What I mean by that is when users are sending cross-chain messages, there's oftentimes fillers and solvers who have balances left on different chains that they need to rebalance and reset their positions. This is where Everclear comes in. Everclear is pioneering a collaborative approach to the chain abstraction future, and they are willing to work with interoperability partners, solvers, and other providers in the space to build a interoperable and chain abstraction future. Check out Everclear at everclear.org, and welcome back to the rollup.
Yeah, so that's super fixed. So you can imagine instead of doing that, or instead of even an oracle that's a trusted oracle, you could have some model that Aave has specified. And anybody who has this model, which they've published, and the hash of the model's on chain, anybody can run that model off chain at their expense. So they're paying for the compute to do that. And they get a ZK proof and they get the output. And that sets the new lending rate for whatever the parameters of the pool are. It's kind of a keeper model, but you don't have to have a permissioned keeper that you trust. You can have anybody do that kind of updating of rates or updating of fees permissionlessly anytime that it makes sense.
Very cool. Yeah, I feel like, this has been theoretically, it makes more sense to have more sophisticated models, more dynamic lending rate models and interest rate models and fee models when it comes to decentralized exchanges. But we've just been limited at the infrastructure level to trusted parties. And we haven't had access to like affordable, fast ZK proofs and verification methods for those ZK proofs and AI and running some sort of inference model on chain. And so the convergence of all these things has really been at the infrastructure level. And then we can now utilize that in the applications. And so you mentioned hooks and programmable pools. And I think that has been kind of like the more recent innovation at the DeFi application level. So before we get into exactly how Maverick V2 utilizes some of this tech, could you just generally explain hooks, maybe how Uniswap uses them and programmable pools in general?
Sure. Yeah. Um, so, DEXs 1.0 and 2.0. So let's just start at the beginning of DEXs, right? So you have this constant product pricing model for UniV1, UniV2, Bancor, the early DEXs. And that's an elegant, super simple way to do it. Gas is really low, but it's not very sophisticated. And it means that there's a ton of slippage whenever you have a trade. And so, the Curve guys, or Michael, came up with this idea of stable swap, where if you have something where the price doesn't have a huge range, you can change the pricing curve to be much tighter around that peg. So that's what stable swap and Curve did. You really need innovation. And so you can think about that as like providing a little bit more degrees of freedom. And then UniV3 was really neat as well. So they created a range AMM. So now you can kind of take that stable swap idea and parameterize it around any price range you want. And getting more concentration gives LPs more return if the price is in their range. And then Maverick V1, we added even more flexibility to that, where you can have arbitrary distributions and you can have the AMM moving your price around. So you can imagine each one of these like generational changes is more flexibility for the LP. What UniV4 does is it says, let's stop prescribing new mechanisms for pricing. Let's just have a mechanism called a hook where anybody can write a smart contract. And on swap, the Uniswap V4 pools, if you set up the pool in this way, will go ask a different contract. It'll say like, this is the incoming flow, this is the state of the pool. Let's go ask this hook contract what we should do about this. And the hook contract can then modify parameters in the pool, modify how the trade is treated, these sorts of things. So hooks let you outsource that complexity someplace else, and it lets you basically create any kind of new pool mechanisms you want without having to redeploy and without having to have Uniswap V5. So there's pros and cons to that. So a biggest con is like, even if you don't do the hooks, there's gas involved in like checking these hooks all the time. And so if you don't have a really neat use case for hooks, I'm not sure that can be a big drawback. Hooks are also they don't kind of provide infinite flexibility. So you still have LPs that own the pool. The Maverick's variation on this is programmable pools. And in Maverick, it's not a hook paradigm. It's more like you have an accessor, a contract that essentially owns the pool and can change any of the parameters in the pool and can decide who gets to swap and when they swap, what happens to the swap before it passes to kind of the core nugget of the pool code. So it's similar ideas, and the high level objective is the same, which is allowing you to insert logic during any pool operation.
Yeah, it makes sense. I think that we saw like this need for more complex interactions on chain as these new DeFi primitives spun up, right? In the beginning, there wasn't so many primitives in the sense of like there was lending markets, CDPs, DEXs, but now like we have, option protocols, we've got various like bond markets, we've got stable coins that are kind of trying to be like either semi-collateralized or backed by different assets. We've got these like basis trading protocols. And so like there's all these different opportunities now to kind of like pick and choose different ways to interact on chain. I know that hooks were kind of a big primitive, and now obviously programmable pools. And want to dive more into the mechanics of V2 and kind of programmable pools and how they work. But real quick, prior to that, we've been exploring this idea pretty through and through over the last couple of months of apps going to launch their own chain, and kind of this idea of app chains and solving the sovereignty problem, the noisy neighbor problem. And I'm curious your thoughts as to like the idea of DeFi apps launching their own chain, selling block space as a business, and whether or not this makes sense for different DeFi applications. There's trade-offs between composability and sovereignty and interoperability and things. So I'm generally curious your perspective on this and how you see this evolution of apps, especially on Ethereum L1, either moving to rollups or eventually moving to their own chain, and how you're seeing this trend from the application perspective.
I guess on one level, I got to admit, I'm not super tied into that. I do know of some apps doing that, and I'm a little bit perplexed by it, honestly. I think in going from Ethereum to L2s, I think that makes lots of sense, right? You get cheaper transactions, and the block space is cheaper, and all these things. I mean, a transaction on Base costs pennies, which is fun, right? You can deploy a whole pool for almost nothing. I'm not sure of the synergy you get by having, just a sole app chain for your app. I guess you can implement some special precompiles in the chain and whatnot. So maybe there's some advantages there. But honestly, I'm not even sure I know the premise. Maybe what have you heard, Andy? What's the kind of big headline of why somebody does this in the DeFi space?
Yeah, I think the idea would be to have just full customizability and control over your execution environment. And I mean, in a world where, if there's a big app on Base, then the fees all of a sudden get, you have to deal with other apps basically taking block space from you or making your block space more expensive. But then also every time that there would be a transaction on Maverick chain, for example, you'd be running the sequencer likely, and there's ways to distribute sequencer fees to LPs.
Sure.
You can internalize these things. But I think the big trade-off would be composability, like how you get liquidity onto your chain and how you would synthesize that amongst other chains. But yeah, I think that's kind of like one of the general ideas.
Yeah, I think getting liquidity there and having it interact with other things there, because now every interaction that you have with other chains is non-atomic, right? Using some sort of messaging protocol to talk to another chain to move liquidity around. It sounds a little bit challenging. But yeah, I mean, you can start making it so that the mining extraction value goes to your users, these sorts of things. But yeah, it doesn't strike me as like a super strong use case. Have you guys seen anybody do it successfully yet?
Yeah, I think there's been quite a few, and I think it'll continue to happen. But I think it's really use case specific with regards to the type of app. But I mean, you guys are expanding to like all several roll-ups. Like, is your strategy here like, okay, we want to be everywhere, or like we want to be in certain places and kind of like dominate more than kind of try to be everywhere? Like, there's like the Uniswap strategy, which is like they're just on every chain. SushiSwap is like a best example of that. I think they're just everywhere. But then you kind of lose that like the brand name in that given execution environment. Like, I'm curious from your builder's perspective on like the multi-chain strategy as well, separate from app chains, like how you're thinking about, okay, how do we expand, but kind of keep this level of brand recognition or kind of dominance in a given environment?
I think it's tricky. I think, we see the big chains come and then they TGE, and then some of them have a harder time holding on. And certainly pre-TGE, there's tons of excitement and enthusiasm there. And then, it's hard to see how things are going to shake out, right? Like, who knew Base was going to be the meme chain when it launched? That's probably was not Coinbase's intent when they launched, right? So, I think, so to answer your question, I think we think of Maverick as just kind of utility that, set of smart contracts that should be deployed in every chain. And V2 really digs into not just the AMM half of this, but other parts of managing a token's liquidity and governance and stickiness. So, the short answer is I think you deploy everywhere so that you are everywhere. We have plenty of protocols that interact with us that say, we're on A, B, and C chain, and you guys are on B chain. If you're not on A and C chain, we can't do that much with you, because then we got to go find somebody on the other two chains that you're not on. So I think it's tricky to just be on a subset of the chains and kind of get the flywheels going, especially with the other bigger blue chip protocols that are multi-chain.
Makes sense. Yeah, cool. All right. Well, I appreciate that. I was pretty curious from the builder's perspective, kind of how thinking about this from the app space. Happy to dive into Maverick V2, and maybe we can just have a foundation as to the main primitives of Maverick V2 and what the upgrade from V1 looks like at each level, and then we can kind of pick and choose into where we want to dive deeper.
Sure. So one of the core upgrades is just the AMM itself. So the AMM has this new flexibility of programmable pools. But if you're not in a programmable pool, if you're in kind of a vanilla pool, the mechanisms, the kind of core mechanisms, we call it a dynamic distribution AMM. You can still distribute your LP liquidity in any shape you want. You can still move around with price if you want as an LP. But the kind of the biggest thing there is actually it's way less gas. So you can do sub 100K concentrated liquidity swaps. And so, we did a comparison the other day. I think Uni V3 is at 150K for a vanilla swap between stable coins tend to be more expensive because they're proxy contracts when you do the transfers. So we're like 50K less than a Uni V3 swap. And that's super important when you start trying to get flow through aggregators and whatnot, because that fixed cost of gas means that you're going to get any trade that's, even if you have a much less depth, that fixed cost of gas is super important, especially for smaller trades. So that was a big focus in the AMM part of the V2 launch. The other neat thing in V2, and I think we're the only AMM doing this, is you can have directional fees. So in every other AMM design, if I put ETH and USDC in a pool, I set a fee for that pool, and I'm now agnostic to whether I'm selling ETH or buying ETH. I get the same fee regardless, which when you say it like that, sounds crazy, right? You're probably not agnostic. You probably want to hold one more than the other or take a bigger fee for one versus the other. So in the Maverick V2 pools, you can actually specify the fee in each direction of swap. And so that may make sense from an LP's perspective if they think there's more volatility, there's big buy side pressure for a new coin or something like that. It's also an interesting, creates an interesting primitive for somebody who wants to kind of dollar cost average sell or buy, because you can basically set the fee in one of the directions so high that you never actually sell in that direction, right? So say you do want to accumulate ETH and you want to accumulate it at some distribution, you can create this distribution of USDC in a USDC ETH pool, and you're kind of counting on the price of ETH going down. In a typical AMM, as it goes down, you get more ETH in your pool. But as soon as it goes back up, you sell all that ETH back. So here with directional fees, you can create a ton of friction to sell the ETH back, and you can basically, you're buying ETH at this distribution that you've created, and you're collecting fee as you do it. So that's a super cool primitive that a couple of folks are kind of working off of to build that as kind of a portfolio management tool, in addition to just kind of vanilla LP.
Yeah, like vaults or something.
Right.
Some sort of like easier operation for somebody like me who doesn't want to manage 12 pools at a time and set all the curves. I can kind of just pick and choose different things and have it be done behind the scenes.
Yeah, exactly. So that's cool. And then the programmability piece. So now you can create a programmable pool and basically, I don't think that's just what like a vanilla user will do. I think protocols will build programmable pools. So there's some stable coins building programmable pools. And the simple mechanism they're implementing is when the price goes below peg, they're going to set the fee in one direction higher. And when it goes above peg, they're going to set the fee in the other direction higher. So some simple fee keeping things, some KYC pools for RWA assets, and some fee setting mechanisms that depend on the volatility of kind of a market. You want to raise the fees when the volatility gets high. So those sort of simple mechanisms for programmable pools, I think, are imminent. A couple of folks are working on those.
Quick question on the directional fee piece and kind of like the dynamic nature of the fees there. Like, let's say I create a liquidity pool. When I deposit liquidity in there, there's other LPs that also provide liquidity into that same pool. So let's say, for instance, I set some fee in one direction, some other LP in the same pool sets a different fee in a different direction. How does the pool itself kind of synthesize the differences in the LP fee structures that myself and another LP in the same pool set?
So it's per pool. So for a pool that's not programmable, you set those fee parameters once when the pool is created, and they're never adjusted again. So anybody can join that pool, and it's not as if the originator of the pool can change those. So that'll be set. So there's kind of no complexity there. For the programmable pools, when you create a programmable pool, you specify essentially we call it the accessor, the owner, the guy or the contract that can set these fees. And so you can set up a programmable pool so you're the only person who can join it. You can set up a programmable pool so anybody can join it, but you're setting the fees for the whole pool. And so that's the kind of how that works, and that's the flexibility there.
And if I set a different fee structure than the originator of the pool, it just creates a different pool with a different fee structure.
Right. If you interact with the UI, what's happening under the hood is you're actually creating a whole new pool with its own LPs.
Okay.
Yeah.
Got it.
And that fragmentation, I think in early DeFi, people were worried about fragmentation, but now with aggregators and all kinds of active bots swapping and whatnot, you don't really have to worry about liquidity being fragmented. Any pool will get action as long as it's got an attractive price.
Nice. Yeah, that makes sense. And also brings to mind some of the more recent conversations on synchronous and asynchronous kind of composability, and kind of solving the fragmentation problem with aggregators or going about a different way to solve that problem. But we'll kind of leave that for maybe another time. You mentioned something on RWAs, and I was curious, are you having conversations with some of the TradFi, some of the centralized finance world? And, we've seen some of the bigger institutions kind of break into the DeFi scene. We've also seen, with the ETFs, crypto kind of take that TradFi route. Thinking about the TradFi coming on chain, have you been having some of those conversations? And generally, now that we have the infrastructure to enable more sophisticated algorithms and models, what do you anticipate these bigger institutions are going to want to do in DeFi? What models do you think they'll want to run? Is this something that they've been asking for? Generally, how can we bring more TradFi on chain and kind of have DeFi eat all of finance?
Yeah, it's an interesting question. So the first answer is we're not really talking directly to issuers. We're talking to protocols who are already on chain, who have done that conversation with the issuers, right? But now they've got this RWA that needs to be KYC. So they got a real world asset, and only some whitelisted group of addresses can touch it from a regulatory perspective. So I think we're still cracking that nut. I think the utility is obvious, right? We all love and appreciate the utility. Permissionless trades, it's super cheap and it's transparent and all these great things. I think we're still at a huge regulatory barriers, right? You can't have RWAs that represent traditional stocks and equities because of regulatory issues. But as soon as you start KYCing, then there becomes an opportunity to do those sorts of things. So that's the nut we're cracking now. I think once that's sorted, or once the regulatory elements are sorted, then the floodgates open. But it's still early days, unfortunately. As much as I think we would all love to have our TradFi portfolios on chain, it's still tricky.
Yeah, it is reassuring, and I'm optimistic now, seeing that these KYC and kind of institutional financial players are still going and deploying onto public blockchains like Ethereum or Optimism or Arbitrum, rather than going and building their entirely new walled garden that is entirely permissioned at the chain and the validator level. At least they're coming on chain to a public chain, and then they're just deploying into a more isolated environment.
I mean, I never really understood they've already got extremely sophisticated infrastructure and rails that they're trusted in. They're giant corporations. So the idea that they need some private chain to facilitate things never really made that much sense to me. So I don't know. It seems like, of course, they should come onto the public chains. Whatever they're going to do in private, they can already do in private. They don't need this technology for it because everybody's already a trusted, entity with all kinds of mechanisms to keep them honest. But yeah, I still think there's a huge opportunity. I think there's all kinds of, if nothing else, retail hunger to get all this stuff on chain.
Kind of switching gears, I'm curious what you think about the emergence of restaking for DeFi and how that's kind of impacted Maverick as well as just the broader landscape, this kind of new yield from Eigenlayer and from restaking. And yeah, just the whole primitive of Eigen token coming out and LRTs, and just how this has changed some of your perspectives in DeFi, or kind of how you're looking to continue capitalizing on this, and just thoughts on the primitive as a whole.
I think it's amazing. I'm super excited about it. I think, one of the things that you appreciate viscerally when you build a DeFi protocol and you've built a Web2 protocol or Web2 app is in Web2, you've got to spend a whole bunch of money on the infrastructure, right? You've got to go pay AWS or Google Cloud or whoever it is. You got to hire a whole DevOps team. because whatever you build for your app has got to live on this infrastructure, and you're in charge of it, and it's a pain in the ass. One of the amazing things about building on Web3 is you build the thing in a smart contract, you deploy the smart contract. The VM, the EVM is your infrastructure. It is your AWS. And what's better is the users pay per use. So you don't have to worry about taking in revenue and then going and spending it on AWS. All that's transparent to you as the builder, and it's just amazing. I think what restaking enables is it enables kind of payment and incentives to do any sort of arbitrary computer action that's verifiable, right? So it lets you create some mechanisms. And I know right now it's just like data availability, right? Like you're paying people to have data available is the big killer app so far. But it scales. So you can imagine some ways that you can do, you're not constrained by just what the VM could do. You get in this Web3 AI stuff. You want to do AI inference. You no longer have to live just in the VM. Through restaking and eigenlayer sorts of primitives, you can have people stake, and they will lose their stake if they don't do the compute or the action they said they were going to do, whether it's hold data or run a model for you or whatever it is. I think that's huge. It's super early days, right? We haven't seen super killer apps there, but I think there's an opportunity to have really big killer apps there. On the kind of like mechanics of restaking tokens, that's also neat. I think it's more tokens for DEXs to trade and whatnot. But the core primitive is, I would say, the coolest part. Everybody loves yield, but the core primitive is super cool.
Do you see more restaking providers coming online, like eigenlayer alternatives that will also kind of contribute to this ecosystem, and or do you kind of see eigenlayer dominating a lot of it?
I think it's going to be like Lido, like somebody else. You're going to have a whole bunch of other people doing it. The eigenlayers, at the end of the day, it's some smart contracts, right? It's not like they've invented a new type of encryption or something. So it's certainly forkable and replicatable, and you could come up with different tweaks here and there to do other things. And if you got a good BD team or a great, momentum or a really neat new angle on it, I think it's certainly possible that somebody else comes in and scoops up a big part of that market as well.
Mantle is a layer 2 blockchain with one of the biggest on-chain treasuries in all of crypto, and they have a 100-day campaign called Metamorphosis live now. What this is it is a campaign for their liquid staked ETH token, METH, as well as their upcoming liquid restaking token, CMETH, where you can utilize this token on the Mantle network in a variety of different apps, some of your favorite restaking protocols and DeFi protocols, and earn yields in the form of powder, which will eventually be turning into a governance token. Mantle's been around for a while. We like them because they use their own form of EigenDA. They have a good ecosystem and they're growing. So check out this 100-day Metamorphosis campaign, and hope you guys enjoy the rest of this video.
Another primitive that you guys are pushing is a kind of a change and improvement to veTokenomics. Curious how you think about this. Like right now we're seeing like a lot of projects deal with like investor dumps and like selling pressure, and like a lot of new launches are not doing so well, and there's just a variety of different factors happening right now. I'm curious what you think about building tokenomics for like long-term sustainability. What is the evolution of veTokenomics? Is this a sustainable path? Yeah, like I think that there's probably a lot to talk about here.
Sure. Yeah, I think so. Part of what's in Maverick V2 is not just so Maverick V1 launched with a VE map token. What we kind of realized in Maverick V2 is like that should be a scalable model that's easy for anyone to replicate, with just a user interface. So you create a new token and you want sticky governance. You should be able to just mint a VE version of your token from a VE factory. And so that's what is in Maverick V2. And the advantage of that is, so one thing that's kind of missing with a couple things. So, you invent a token, you need some market for it. And so you need some liquidity for it. You need people to stake it pools. You need people to stake it against ETH or dollars or something so that there's liquidity in both directions. So these are all the kinds of things you need in the beginning when you're launching a token. And so one way to do it is just you put incentives into a pool, whether it's through Maverick or some other interface. Sushi kind of invented that idea, and Curve innovated on it. The problem is if you just are giving incentives in your raw token, people will take the incentives. They're just super mercenary. They'll take the incentives and they'll dump them, and that can be fine. Maybe that's there is a use case for that. I think what's missing in that typical that like V1 sushi model is you want to encourage people to have your token in a sticky way, to kind of believe in the protocol and advertise or get some benefit for sticking around. And so that's kind of missing in that whole emissions model where there's no stickiness. And that's the beauty of what Curve came up with the VE model in the first place. Is there's some stickiness. You can stake. The more you stake, the more advantages you get. You get more LP returns. You get more fee returns. But in the Curve model, only the CRV token like experiences all that. And so what we realized in working with a whole bunch of projects is like there's an appetite to have that sort of stickiness, to have the Curve or GMX flywheel for an arbitrary token. And so that's what's going on here. So now you can mint a VE token for your base token. You don't need a MAV token involved at all. You can go incentivize a pool with your token, and you can have it so that people who own your VE token get the boost. So all that looks very Curve-like. You get a boost if you own more token. The emissions, you get more if you take them in VE versus not taking them in VE. And all that's tunable by somebody who creates the VE token or a pool and the VE token. So the whole idea is you go to a new chain, you got all these new tokens. Maverick V2 is trying to enable that flywheel, not just the liquidity part, but all the parts on top of liquidity.
So anybody can come to the VE factory and launch a VE token?
That's right. It's so the VE contract is not owned. It does have some opinions about how emissions work and these sorts of things. But yeah, you could go take USDC and mint VE USDC. That will be the only VE USDC that comes from this factory. And people can stake USDC in it. They'll get some voting power, VE voting power. You can actually airdrop to holders of that VE token, pro rata of the VE. You can airdrop any token you want at any future time stamp you want, which is pretty cool. And then you can set up a Maverick V2, we call them boosted positions. And you can incentivize with USDC, and you can click a button basically that means that as people get emissions in USDC, they'll get a boost if they have more VE USDC, and or they'll get a boost if they stake longer. So that's the kind of Curve element. But and none of that flywheel is the MAV token involved. You're able to do all this with your own token. USDC is not a great example because it's a stablecoin, but you can imagine any new token that comes out, you could do that whole thing with. Gotcha. And so I think like WAGMI fair launch on base, so this idea of doing fair launches in a Maverick pool is something that a couple of folks are working on. So WAGMI fair launch uses a Uniswap pool. The whole supply gets minted to the pool, and then you're not going to get rugged. There's folks working with Maverick to have not just that piece in a Maverick pool, but also have the VE version of the new token and all this other stuff built out, which hopefully makes a more robust new token ecosystem for that token.
Gotcha. Cool. Well, I think the last question that I have is kind of what's next for DeFi? Where does DeFi go here to achieve more product market fit outside of our community? What are some innovations that you're particularly excited about? And what does the next 18 months hold for Maverick and also for DeFi?
Yeah, I mean, just looping back, I think it's the AI DEX narrative, seeing that play out, seeing more sophisticated operations happening inside of DEX trades. That's one element. And then hopefully with, again, both programmable pools and uni hooks, better, more nimble KYCing and that sort of stuff. Maybe that makes it so RWAs catch more traction than they've caught so far. I think there's huge appetite for RWAs in the real world. I think we can move that all back to Web3. So yeah, those are the two kind of angles I'm most excited about.
And then what's on the agenda for Maverick there?
So there's still tons of building to do for Maverick. So we've kind of built these primitives and just launched last week, but now we got to go build out programmable pools. We got to go help these protocols who are building out the fair launch thing do that. And so there's still tons more to do in that space, kind of build on top of all these primitives that we just released.
Awesome. Rob, you got anything else to close us out?
Not a whole lot. I think this was a pretty good deep dive into some of the more modern DeFi instruments. I do have questions for Bob that revolve around quantum computing and information theory, but I have a feeling that probably won't make it into the episode. So we'll save those for next time. And yeah, it's been a pleasure, Bob. Thanks for coming on.
Yeah. Thanks, Rob. Thanks, Andy. Great being here.
Cheers, man.
Cheers.
Yeah.